Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about i3 Verticals Inc. quarterly report. i3 Verticals Inc. offers a diverse range of business services to public sector entities in the United States and Canada. The company's software and service solutions cater to various needs, including court systems, transportation departments, schools, and government agencies. The company provides digital solutions for court systems, such as e-filing and revenue cycle management, as well as computer-aided dispatch, records management, evidence management, jail management, mobile solutions, and LiveScan. In addition, i3 Verticals offers software solutions for vehicle title and registration, driver's license and permit management, and motor carrier compliance. The company also provides digital customer engagement platforms, including web, mobile, chat, and voice options, as well as billing and back-office management software solutions and services. Furthermore, i3 Verticals offers solutions for school lunch programs, including meal account management, point of sale, menu planning, nutritional analysis, food inventory, and free and reduced meal applications. In addition to these services, the company provides government fund accounting software, digital land record solutions with AI indexing, computer-assisted mass appraisal solutions, licensing and permitting solutions, and tax and revenue collection management solutions. Overall, i3 Verticals, Inc. offers a comprehensive range of business services that cater to various needs of public sector entities in North America. The stock price of i3 Verticals, Inc. has dropped by over 28% in the past year due to several key events and factors. The company's transition from a diversified business model to a pure-play public sector software provider has been a significant contributor to this decline. This transition, which involves divesting non-core businesses such as healthcare and merchant services, has led to transitional pain and near-term volatility. The fourth quarter of fiscal year 2025 saw a slowdown in adjusted EBITDA, partly due to a planned decrease in higher-margin license revenue and increased product investments. The company's first quarter fiscal 2026 results were also disappointing, with diluted earnings per share, EPS, significantly below analyst expectations. Revenue declined by 14.6% year-over-year. Net income attributable to common shareholders plummeted 76.5%, and operating profit fell 40.4%. The revised fiscal 2026 guidance did not offer much relief to investors, as it indicated that non-recurring professional services revenue from utility and transportation projects would be pushed into fiscal 2027. These disappointing results led to the stock tumbling nearly 4% and reaching a new 52-week low on February 5, 2026. Overall, i3 Verticals' struggles with its business model transition and financial performance have been major drivers of its stock price decline in the past year. i3 Verticals, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. i3 Verticals, Inc. trades at a higher price-to-earnings ratio of 262 times and a lower price-to-book ratio of 1.38 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 19% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of key business activities. On the growth side, acquisitions and volume-based payment processing fees have contributed significantly to increased revenue. Additionally, sales of subscriptions, recurring services, licenses, and installation and implementation services have also driven growth. Interchange and network fees, as well as annualized recurring revenue, ARR, from various sources such as SaaS arrangements, transaction-based software revenue, and payments revenue, have also played a crucial role in driving revenue growth. On the other hand, the sale of certain business units, including healthcare RCM business and merchant services business, has led to revenue decline. Furthermore, the discontinuation of the merchant services business and a decrease in non-recurring revenues have also contributed to the decline in revenue. These factors highlight the importance of strategic business decisions and market trends in driving revenue growth or decline. The financial performance of a company underwent significant changes between 2024 and 2025. Net income experienced a substantial decline, decreasing from $3,108,000 in 2024 to $947,000 in 2025, representing a staggering drop of 69.5%. This drastic reduction in net income was the primary reason for the decrease in profit margins. The operating income margin and net income margin both saw a decline, dropping from 3.9% and 5.9% respectively in 2024 to 3.1% and 1.8% in 2025. The significant drop in net income was directly responsible for this decrease in profit margins. As a result of these changes, the company's financial performance took a hit, indicating areas that require improvement to regain stability and growth. The company's financial performance indicates a positive trend in its operating cash flow. The data shows that the net cash provided by operating activities has increased significantly over time, with a notable jump of $2.6 million in 2025 compared to previous years. This increase suggests that the company is efficiently managing its operations and generating sufficient cash to meet its financial obligations. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes. The total amount borrowed under the revolver can now exceed $400,000 without penalty, indicating an increase in debt level. However, as of December 31, 2025, no borrowings were outstanding under the 2023 Senior Secured Credit Facility, but available borrowing capacity was $400 million. On the other hand, interest expenses have decreased significantly. The company's interest expense has dropped by -44% from $680,000 in 2024 to $381,000 in 2025. This reduction is attributed to a permanent decrease in aggregate lender commitments under the revolving line of credit. As a result, the company's interest expenses have changed significantly due to this reduction. Management is optimistic about the company's outlook and strategy for growth. One key aspect of this strategy is managing debt through the 2023 Senior Secured Credit Facility, which will provide financial flexibility. The company's growth strategy focuses on mission-critical enterprise software and services solutions for public sector customers. This approach prioritizes revenue from recurring sources and uses ARR as a key performance indicator to measure success. Additionally, management plans to fund acquisitions through a combination of cash on hand, operating activities, borrowings, and equity/debt issuances. Financially, the company aims to use adjusted EBITDA margin as a non-GAAP measure to assess operating performance. Management also expects sufficient cash flow from operations, current cash, and available borrowing capacity to fund its needs for at least 12 months and the foreseeable future. Furthermore, the company plans to repurchase up to $50 million of outstanding shares. Overall, management's strategy emphasizes financial discipline, growth through strategic acquisitions, and a focus on recurring revenue streams. The company's recent financial activities have been marked by a significant move to repurchase its own shares. According to the available data, the company has bought back a substantial number of shares, totaling 1,522,838. This strategic decision was made at an average price per share of $24.88. This move is indicative of the company's confidence in its future prospects and its desire to return value to shareholders. By buying back shares, the company is essentially reducing the number of outstanding shares on the market, which can have a positive impact on earnings per share, EPS, and potentially boost the stock price. There are growing concerns among businesses and experts regarding the accumulation of excess inventory and potential disruptions to global supply chains. Inventory buildup can lead to wasted resources, increased storage costs, and decreased efficiency in production and distribution processes. Supply chain disruptions pose a significant threat to companies that rely on timely delivery of goods and materials from suppliers around the world. Disruptions can be caused by various factors, such as natural disasters, transportation bottlenecks, or unexpected changes in demand. That concludes the financial summary for i3 Verticals Inc. Feel free to comment below, and I will be happy to answer them when possible.